Good afternoon and welcome to another edition of Money Matters. My name is Dan White. I am the host of your show this afternoon, and I'm also the president and CEO of Daniel White and Associates. We are a retirement planning firm headquartered in Glen Mills, Pennsylvania. We also have two satellite offices, one in Middletown, Delaware, and one down a little further south in Lewis, Delaware. And we work primarily with retirees and pre-retirees, setting up those income streams, managing risk, legacy planning, tax planning, the whole nine yards, all the decisions that a person has to make as they enter the retirement landscape. And before we get into the program, everybody kind of asked us, what's the market going to do? Where's the market heading? And the correct answer is nobody knows where the market is heading. But I will say it was an interesting last couple of weeks because drum roll, please. President Trump finally announced a new Fed chair. Unless you've been sleeping, you've noticed that President Trump and Fed Chairman Jerome Powell have been feuding, back and forth for 6 to 9 months. President Trump was threatened to fire Chairman Powell. We don't know the legality of that, but he wants lower interest rates. And Chairman Powell, to his credit, he has not acquiesced to President Trump's demands. He's held the course. They have lowered rates a couple times, but they seem to be more of an independent body. And everybody kind of thought that, whoever President Trump nominated was going to kind of be his guy, his puppet, that'll do kind of what President Trump wanted and lower interest rates. I mean, the government definitely wants interest rates lower because of the interest on the debt that we owe. I mean, every tax dollar that they collect, 25 cents of every dollar is now going to the interest on our debt, which is over $38 trillion. So he wants lower interest rates, and everybody thought the Fed pick would kind of be that. But President Trump officially nominated Kevin Warsh to replace Jerome Powell as chairman of the Federal Reserve. And when this happened, the markets didn't wait for confirmation to react. Gold took a nosedive. Silver plunged over 30% in one day. The bank stocks rallied, and traders were kind of scrambling to understand what this meant. And the big question, Warsh is a lawyer and a former investment banker. He was the youngest governor in Fed history from 2006 to 2011. So he does have some Fed experience. But, it's kind of like, is he a hawk or is he a dove? Where are interest rates going to go? And there's a couple different things. Everybody thinks he's going to be a dove on interest rates. He's going to lower rates. He wants to cut interest rates for the consumer. He wants us to be able to have access to more money. But at the same point in time, he's probably going to be a hawk on the balance sheet, right? He wants to cut rates, but he wants to aggressively shrink the Fed's $6+ trillion balance sheet. He views the Fed as being very bloated, and he wants to force Wall Street to stand on their own 2 feet without the Fed always acting as the backdrop. So he wants to do quantitative tightening. He wants to reduce the Fed balance sheet. So again, the market's reaction to the announcement was immediate and pretty violent. They were calling it, traders are already calling it the Warsh effect. Gold prices collapsed 15%, silver collapsed 30%. Why did this happen? Because gold bugs have long bet that the Fed would eventually monetize the debt and then everybody would run to gold. And that's why gold and silver had the intense run-up that we've seen. But when he got announced as Fed chairman, that kind of collapsed. Bank stocks were the winner. Everybody thinks that, we might have more higher interest rates, and that would certainly benefit bank stocks. And with crypto kind of went in the nosedive as well. It fell about 7 or 8%. So initially, it remains to be seen how this is going to play out in the macroeconomic sense. We still have some fractures. We're near all-time highs. Today the job report came in. The job report was a blowout. They added probably 100,000 more jobs than what they expected. This is not good for those people that want rate cuts, because the whole reason the Fed was cutting rates the last 3 times before the pause was the job market. The job market was in the toilet, and the Fed said, well, we're cutting rates, inflation be damned. we're not worried about inflation. We're more worried about the job market. With this most recent job report, it's you're probably not going to see lower interest rates anytime soon. Now, that being said, will inflation continue to increase? That remains to be seen. The other thing is we are still seeing that very K-shaped economy. So those people that own assets, that own stocks, that own real estate, they're seeing a great increase in their net worth. But those people that don't, the bottom leg of the K economy, we've got defaults on student loans. We've got defaults on credit cards. So you have the haves and the have-nots. The haves are getting richer and the have-nots are getting poorer. And that's never a good combination. It leads to political unrest, social unrest, and that's kind of where we're at. So, we're near all-time highs. The economy is doing very well. The GDP for the fourth quarter is likely to be north of 4%, and it has been the third quarter, the second quarter. So the economy and the job market looks stable. Everything's running on all cylinders, but we have to worry about the haves and the have-nots, and obviously inflation is going to rear its ugly head probably at some time in the future. So that's kind of our market update, if you will. I think that the correct response is prepare, protect, don't predict. Be prepared, but don't predict what's going to happen. So that being said, we do have a question from one of our listeners today. The question is from Justin Goldman in Philadelphia. Justin wants to know, what are the advantages of international mutual funds as an investment? Well, Justin, that's an easy one. For 50 years, the U.S. market and the international markets have kind of run neck and neck. Now, that being said, 2008 changed all that. After the Great Recession, the place to be the last 20 years, more or less, has been the U.S. markets. The U.S. markets have just soared, while the international markets have lagged a little. But if you really subscribe to the reversion of the mean mentality, that's got to catch up eventually. And we might have a correction of some sort in the U.S. markets. For the last 6 months or so, the international markets have outperformed the U.S. market. So you want to have some diversification. You want to have some exposure to the international market. It just goes back to correlation. It goes back to perhaps, you don't want to have all your eggs in one basket. You want to have, when one asset's going down, you want to have another asset going up. And it's probably a good time to have some of that international exposure in the stock position of your portfolio. So that's the advantages. I mean, they could be doing different things while the U.S. market is going down. So if you've got a question for Money Matters, here's how you can ask that question.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com. On our homepage, click on the banner on the right that says, Send us your questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
All right, welcome back. And I'm proud to say that we have a guest on our show today. Our guest is Pedro A. Rojas Arroyo, the founder and CEO of Vivy Tech. I'll give you a little background on Pedro. The founder of Vivy Tech, a business revolutionizing the development and use of technology for social good. Pedro is a speaker, an entrepreneur born in Venezuela. He began his political career at the age of 14, rising to the position of young leader before political persecution prompted him to pursue international endeavors in fashion, music, events, and diplomacy, for which he was awarded the Queen Elizabeth II International Jubilee Merit. Pedro is currently responsible for driving Vivy Tech's mission-driven growth in the fields of finance, defense, sports, and commerce, with a focus on innovation and ethical AI for underprivileged areas, driven by an unquenchable curiosity and a passion for shaping the future. This international relations and economics student, who also attended Harvard, continues to explore a range of subjects, including quantum physics. Welcome to the show, Pedro.
Doing. Thank you very much for having me, Ben.
Yeah, why don't we just start by letting you talk a little bit about your company and what it is that you do exactly.
Thank you very much, for sure. So Vivy Tech, it's one of the most innovative companies I've ever seen because it's using a business model that is not classical. We're a venture studio. Basically, we are a company that it's one big roof for innovators to create inside of the company. So picture a venture capitalist in which we do investments for profit, but at the same time, picture an incubator in which we promote these startups and these founders, and we give them the tools to create. So we are giving them the tools to create at the same time driving profit, but also under the same roof that lets us expand into many fields at the same time with less resources than a traditional company.
So who would be the primary customer?
Product that we're talking, we have some products that are on defense, in which the primary customer would be governments, but we also have products that are B2B, B2C, in which the primary customer is the common people, your average Joe, down in Latin America, in Florida, here in Massachusetts, all around the world.
So the markets right now are kind of shaking around the world. You know, the investors are asking if the investors should sell, should they hold, should they buy the dip? You know, from your experience in finance and tech, what should everyday investors know before they make a knee-jerk decision right now?
Well, the first thing a good investor should know is that research is the key for every decision. And I'm saying this because I don't want anybody to take a decision based on what we're saying, but to actually start a research based on what the answers of this conversation would lead to. But being more specific around some tips and what I'm feeling in the market right now, obviously uncertainty is a big factor, and the military realm is expanding, and war brings uncertainty. And that's why we have seen so much variation in assets that tend to be more flatlined, like gold and silver. I think the number one thing that people should look for in 2026 and 27 with regards to investment is the capacity for that investment to be reconverted into ultra liquid assets, meaning cash. I think when money gets tied, especially in circumstances of high uncertainty, big losses can occur.
Yeah, it's kind of interesting you mention that. I mean, you know, we're sitting at a U.S. stock market anyway that's by practically every metric you look at, it's at an all-time high. I mean, as far as valuation and being ultra expensive. So, you know, when you're looking at that and you're saying, you know, Warren Buffett's sitting on a hoard of cash and everybody's sitting on cash, you know, like when's the other shoe going to drop? What do you advise people when we're looking at this?
I think the number one thing to look for in this type of a scenario, it's revenue to valuation ratio. So, for example, companies like NVIDIA are making a quarter of the valuation of the company, or even less. So, in a traditional scenario, we could totally state that these companies are overvalued, and it is a bubble, and it could pop in any moment. But that's the tricky part about the stock market. Sometimes it's driven by the laws of economics, supply and demand, and other times it's driven by mere speculation, and there is no warning sign of what's going to happen.
Yeah, that's true. I mean, I think that's kind of where we're at. You look at the traditional things you look at in valuing companies and that kind of thing. And, you know, one of the things I say to our clients all the time is the way you have to look at it is through the lens of, if I didn't own this position now, would I buy it? Would I buy it today? Because if you wouldn't buy it today and you own it, then you probably shouldn't own it, with the valuations where they are. But I notice you have built companies that are based on mission and innovation. In the age where emotion often drives the market behavior, how can investors stay rational or stay focused even when headlines are scary?
Okay, so yes, that's a complicated question because not even I can stay put sometimes. But I think the number one thing, if the investing comes from the research and from your hard work, is to stay true to why you started and stay true to what you believe it's going to happen. Many people will talk, many people will try to talk you in or out of investments. At the end of the day, your research and your judgment after a comprehensive session of researching. I'm a big advocate for researching, as you can tell. It's what's going to matter.
It's funny when, I don't think a whole lot of investors out there really do much research at all. I
Yes.
mean, I've had clients come in here and say, yeah, I said, where do you think the market's heading? And they're like, oh, for the next 3 years while Donald Trump's in office, it's going up. I mean, it's like the guy can do no wrong, according to people in their eyes. The market's just going to continue to go up. How do you kind of get them to, caution their attitude toward that, hey, this thing is probably, it looks more like a bubble than not.
I think it's when you start looking at the markets with logic and you comprehend that no magic dollars are going to appear and that there's always somebody at the other side, at the other end of the investment. When you wish something is going up, there's always someone that wants it to go down. So when you understand that and you understand the logic of the markets, then you realize that bubbles can appear, and if too many people it's on one side of the market, there is definitely going to be an arbitrage opportunity for the others, and they are going to exploit it.
Yeah, it does look a lot. The AI situation does look a lot like the internet, from 25 years ago, where you had a lot of companies spending a lot of money and there was no profits. I mean, it was worse back then. You look at the companies today, you got Microsoft throwing them, trillions of dollars at this. You got Amazon. These companies are real companies. I get that. As opposed to the internet companies where they had no earnings, no nothing, and they were getting bid up to the moon. But it does look a lot like that, where you're spending all this money and everybody's saying, but there's no profit. We haven't made anything on this AI stuff, So where do you see AI going, and when do they start generating revenue?
So the number one problem here is that these companies are not too many, and there are a highly sectoralized part of the economy that basically flows capital in between them. So when you actually see where the money comes from and where the money goes, it's always the same 8 or 9 companies. That is, for me, a bad sign. And in terms of where AI is headed, I think AI in terms of technology and innovation is going to great places. But I also think there are highly unstable situations about to happen regarding the monetization and profitability of the markets using AI. I think it was overstated what AI can do in the short term to some business. The adoption was massive, especially on some places where AI shouldn't be playing a role in. And what we're seeing today is everyone is using AI, and some big companies don't even know what they are doing with it.
Yeah, so you mentioned instability, and let's just go out and take a bigger picture and go a little bit to the global markets. Venezuelan markets and politics are, as we know, in flux after the capture of Nicolas Maduro and the leaders and the interim leadership shifts that are going on there. The recent capture of Maduro and the interim leadership have created developments, and they're changing investor sentiment across Latin America. Where do you see that all heading?
I think Venezuela is headed to a great direction, to be honest with you. We are handling several funds that are being created in this exact moment from Venezuelan companies and investments in Venezuela. And we're using analysis from several institutions at the same time, and they are all pointing the same direction. The revalorization of the economy, it's about to happen. It's about to happen gradually, but big. I think Venezuela is the number one place where people should be looking in 2026 for investments that are not, I would never say an investment is guaranteed to go up, but it's very hard that it goes down in a situation in which was Venezuela 2 months ago.
Yeah, it was interesting. We had our question. You were probably listening to it from a viewer, and he was saying, "What are the benefits of using international mutual funds?" And I talked about correlation and just having some exposure to different markets. And Venezuela would be a great opportunity there as well. What other opportunities do you see globally other than Venezuela?
Other than Venezuela, I will point my eyes to Asia. I think Asia is going to be the winner of this decade. I think when we look at the macro perspective, you got some players that are gaining immense economical power. And even though some traditional players like Japan are having rough times, when we turn and we look at South Korea, when we look at China specifically and their economic zones, when we look at the Gulf with the UAE and Saudi, we just see big players taking the field in global commerce, innovation, technology, and all the new inventions that we are seeing in the United States are actually also in Asia by Asian companies with half of the valuation as the American companies and double the market. So I think Asia is a big player to look for.
It's interesting, and I gotta ask the question about the elephant in the room that I've been talking about for 5 years, but nobody seems to care. Is not only the U.S. We know the U.S. is 38.6 or 38.7 trillion, and the whole Japan is no better, right? And they just went through a 30-year period where they had no return in their stock market. There's countries around the world that the government spending has just gotten completely out of control. When does that become a factor?
It becomes a factor the moment we realize that we are too deep in the hole. In the United States, it's about time that we realize that, but because there are several countries that are also in the hole. Japan is a great example, but half of Europe is also a great example. When you look at Spain, for example, Spain is spending tons and tons of money on these social programs, on everything, and it's unsustainable. And when you follow economic theory, you normally see that government spending at such a high surplus, it's traditionally not good for any of the schools of thoughts in economics. I would be very, very concerned if I had some investments in countries like Spain or the rest of Europe.
So I've listened to a couple people, and I read quite a bit, and they all talk about the global reset. At some point, we have to reset the system. I'm not even sure what that looks like. What would a global reset? What do we just wipe the slate clean and say nobody owes anybody anything?
I certainly think it's gonna look something like that, but it's not that that nobody owns anything. It's gonna be that a small amount of people are going to own a lot of things, and things like, for example, when you look at this new trends in regards of politics, like this neo-nationalism that is growing in males of Gen Z, we see that there is going to be a reset, and it's happening right now, not only in economics but in politics, in the culture, in many realms. We're having a reset, something that is not what we know, and we're going back to square zero. I believe it's going to be a good time for the ones that know how to take advantage of it, but a very dangerous time for the ones that are not prepared.
Yeah, it's kind of interesting. I mean, I'll go back 20 years, but this is history, and it's still playing out how it's going to impact things. But after the Great Recession, the U.S. took interest rates to zero. Well, Europe even took it a step further. How many billions of dollars and trillions of dollars of bonds had negative interest rates? And I still can't even wrap my head around what a negative interest rate is. So I take out a mortgage, you pay me to buy the house, right? But so they have consequences. Obviously, these negative interest rates and zero interest rates have, and we kept it at zero for a better part of 15 years. That's why housing is unaffordable now, right? Everybody
Exactly.
refinanced at 2%, and now rates are 7%, and they don't want to give up their 2% mortgage.
Exactly.
We're seeing that play out around the globe. How do we rectify that situation?
I think it's going to be complicated, but I think a good way to picture it is with the experiment of President Milei in Argentina. I think when you take into consideration the state in which Argentina was and the state in which is now, you see that it is possible to come out of the hole. When we talk about these negative interest rates, yes, for me also they make no sense. And I think they are the main reason for why an economy such as brilliant as Japan has so much time in the hole. But when we see how to get out of it with these economic pro-Austrian school techniques, we see that the future is going to be bright, but the short-term impact is not going to be as great. But it's a necessary thing to go through.
One of the things I mentioned earlier is, and this is another repercussion of low interest rates, was it benefited people with assets, right? So if you own stocks, if you own real estate, when money was free, we didn't get inflation. Everybody's like, oh, we're going to have inflation. Well, we did get inflation, but it wasn't in prices, it was in assets, right? Real estate skyrocketed, the stock market tripled or quadrupled. So that's great if you own it. But in the US, we have a whole lot of people that don't own any of that stuff. And that's why I talked about that K-shaped economy. The rich get richer and the poor get poorer. And that's not a good scenario, because ultimately it leads to discontent and discord and rebellion and God knows what, social unrest. So where do you see all that head? How do we get
100%.
groups closer together?
I think with what we have right now, the policies we have, it's not going to happen. When we look at how things have gone 3 times or 4 times as more expensive, but money is now worth almost 70% of what it was worth 10 years ago, then we come to the realization that the people who owned stuff in the past are the ones that own stuff today and are going to be the ones that own stuff tomorrow. And I'm sorry to sound this way, because it doesn't help entrepreneurship thinking, but it is just the way it is. Now, to be an entrepreneur in these days, it's a bit more complicated than what it was 20 years ago.
Yeah, it certainly is, and I'd like to say that we see a way out of this, but I'm really not sure how it's going to resolve itself. But I think the key, like I said earlier, is that you have to prepare, not predict what's going to happen, and buy good, solid companies, dividend-paying companies, and that kind. Go back to, like you said, the ABCs of investing, and you should be okay. Well, we're just about out of time, Pedro, but I really want to thank you for being on the program today, listening to your insight on things.
No, thank you for having me.
You're more than welcome. And our next guest on next month's program will be Chris Arambula, the now CFO. He'll be our guest on the next edition of Money Matters. So I hope everybody enjoyed the show this afternoon. And until next month, have a great month. Take care.